Warren Buffett's advice on how to get rich. This is the Forbes World Billionaire List. If you look at the top 10 wealthiest people here, a pattern emerges. Tech billionaires who created a revolutionary product and got rich fast. Bill Gates, billionaire within 12 years of founding Microsoft. Larry Page, within 6 years of founding Google. Jeff Bezos, 4 years. One man, however, built his wealth much more slowly. Warren Buffett became a billionaire at the age of 56, 27 years after starting his first partnership. He did not create a revolutionary product or invest in a tech startup. He kept investing and let compounding do the job for him. Something that virtually anyone can do. For an average person, creating wealth in the Warren Buffett way is much more realistic. So, here is the best advice from Warren Buffett on how to get rich. Warren Buffett has always been against the use of debt, so naturally his first advice is to pay off your high interest or bad debt. The S&P 500 averages around 8 to 10% in return over the long term. If you're a millennial and attended college, you have most likely racked up student loans and credit card debts. An average American graduate is $38,000 in debt, and about $8,000 is high interest debt like credit card debt or auto loans. Considering the recent interest hikes, you can expect to pay anywhere from 20 to 24% on your current debt. If you invest that $8,000 in the S&P 500, you can make up to $800, but if you pay off your credit card, you will not need to pay $1,800, effectively making an extra $1,000. So instead of focusing on where to invest, focus on paying off your bad debts. These debts hold you down and will be the biggest hindrance between you and your financial freedom.
Avoid credit cards. Just forget about them. You're going to be paying 18 or 20%. And you can't make progress in your financial life going around borrowing money at 18 or 20%.
Now that you've paid off your bad debt, here is the second piece of advice from Warren Buffett. Start as early as you can. Buffett personally bought his first stock when he was 11. Yes, you heard that right, 11. But started investing seriously when he was 23. So don't get disheartened. Buffett made billions by investing in good companies and letting it compound for years and years. Compounding is like rolling a snowball down a hill. It starts slow and then you have to put a lot of effort at the beginning, but once you have given it enough time, it starts to pick up and grows exponentially. The longer the hill, the larger your snowball. And as Charlie Munger says, the first $100,000 is always the hardest. Think of your investments like the snowball and your age as the hill's height. The longer your portfolio has to grow, the better it gets. Here is an example to give you an idea of how important an early start is. Let's say you are 27 and start investing $500 in the stock market monthly. By 57, you will have almost $1 million. If you had started 10 years earlier though, you would have $2.7 million. Just 5 years earlier than this, $4.5 million. Sure, a 17-year-old kid won't have 500 in most cases, but you get the idea. So how should you start investing? Warren Buffett has two distinct pieces of advice for two types of people. For 99% of the people, the advice is simple. You can't beat the market. So don't pick individual stocks. Instead, invest in a broad index fund like the S&P 500. S&P 500 is an index that tracks the 500 largest companies listed in the US stock market. So if you buy it, you buy the market. Most people simply don't have the mindset to make money in the stock market, so this is the best option. If you invest in a specific amount every month and not care whether the market is up or down, whether we are in a recession or inflation is high, you will be rich. Because, in the long run, stocks always go up. And if you try to pick stocks or time the market, you will probably lose money. Even hedge fund managers, whose only job is to pick individual stocks and beat the market, can only beat it sometimes. Don't believe me? Here's a quick story for you. In 2007, Warren Buffett placed $1 million bet to prove a point about investing. He bet that a low-cost S&P 500 index fund would outperform a basket of hedge funds chosen by a group of investment professionals over the course of 10 years. The bet was simple. If the S&P 500 index fund did better than the basket of hedge funds, Buffett would win the $1 million. Buffett argued that hedge funds charged these ridiculous fees that were not based on performance, so fees ate any return they made. You would think hedge funds jumped at this opportunity to prove themselves, but initially no one did. Eventually, Ted Seeds, a hedge fund manager at Protege Partners LLC, accepted the bet and a decade-long experiment started. Ted chose a basket of hedge funds that he believed would beat the market. Buffett chose a simple index fund. And, as it turned out, the index fund did outperform the hedge funds. By the end of 10 years, the S&P 500 index fund had returned 85.4%, while the average return of the hedge funds was only 22.5%. So if professionals who dedicate their lives to picking stocks can't do it, you probably can't do it either. In fact, after his death, Warren Buffett wants all of his wealth to be invested in a diversified index fund like the S&P 500. But if you look at Warren Buffett, he didn't make his money by buying index funds every month. He made it by picking individual stocks. And he absolutely crushed the S&P 500. If you had invested $100 into the S&P 500 every month when Warren Buffett started Berkshire Hathaway, you would have around $1 million. But if you invested that with Berkshire Hathaway, you would have a mind-boggling $120 million. So, what does Warren Buffett advise for people who want to invest like him and be in the top 1%? Warren Buffett has averaged at around 20% CAGR in his 70 years as an investor. But this return was much higher during his early years. He averaged around 70 to 80% when he started out and still thinks he can do that. How did he achieve such ridiculous returns? This is what Warren Buffett calls the advantage of working with small sums of money. But before that, this advice is only for people with a contrarian mindset who can stay disciplined for a long time. Here's the thought process. You make money in the stock market by finding stocks that are undervalued. But big companies are constantly covered by analysts and big hedge funds, so there's very little chance any stock is undervalued. But what about the small companies that the analysts don't care about? This is how Warren Buffett made his first millions, and you can too. A company worth $10 million might be selling in the stock market for $5 million, but for a $10 billion hedge fund, even if the share price triples, it will make little difference. So these stocks are largely ignored by the big guys, and the small guys get their chance. Warren Buffett usually bought companies selling at prices below their book value. For this, he would go through the annual reports of hundreds of small companies that no one cared about, and occasionally he would land on a gold mine. For instance, if a company has assets worth $10 million and liabilities worth $4 million, it's worth at least $6 million, right? But what if the company was selling for $4 million? You would make a massive 50% return even if you liquidate the company. One of the best examples is when Warren Buffett bought Sanborn Maps in 1958. It was a small company with around $65 share of liquid assets, but was priced at only $35 per share. Warren Buffett went all in and sank more than 60% of his money in a single company. He eventually convinced the board to liquidate and made an insane 70% return on that trade. You can find information on small cap companies on many websites, and the principle stays the same. Just read through hundreds of companies and occasionally you will find something everyone has overlooked. Maybe it's the portfolio of stocks in the company's balance sheet, which has increased in value, or real estate in an area that has seen huge developments. Whatever it is, if people overlooked it, you have just landed on a gold mine. You do need to be careful though. When something is too good to be true, it probably is. In most cases, when a company is selling at a ridiculous discount, there's something wrong. You could have bought Lehman Brothers in 2007 when it traded at a PE of less than 1, but it was on the verge of bankruptcy and later went bankrupt. Small cap companies have a lot of inconsistencies with their balance sheet, and there are a lot of problems like overvaluing their assets or undervaluing their liabilities. So, you won't just have to go through financials, you will need to do a lot more research, and even after all this, the vast majority of people who try fail. So, what do you think about this advice from Warren Buffett? Do you have what it takes to be in the top 1%? Comment down below, and I'll see you in the next one.